When life gets more complex, you have things like stock compensation, deferred compensation plans, maybe investment income. It's hard to shake the feeling like you might be missing something. You're not just trying to avoid mistakes. You want to make sure you're making the best use of every opportunity, especially when it comes to taxes, where the cost of inaction or the wrong move can actually compound over time. In this video, I'll walk through 4 ways to approach taxes more thoughtfully over your lifetime, not just this year. From tax-efficient investing to smart deduction planning, we'll cover the strategies that help you stay proactive, reduce regret, and feel confident you're not leaving money on the table. I'm Emily Harper with Monument Wealth Management. Let's dive into talking about the 4 ways to be more intentional when it comes to tax planning. So first, it's important to think about creating tax diversity in your retirement savings. When you're earning a high income, it's really tempting to want to reduce that income as much as possible to pay as little in taxes right now. But when you maximize those pre-tax contributions to things like your 401k plan or even deferred compensation plans where you can save even more and reduce your taxable income now, you may actually be creating a higher tax cost for yourself in the future. When you have to start dipping into those accounts, either because you need money to live off of or because there's mandatory distributions you have to take from your IRAs, your 401ks, or even those deferred compensation plans, which may pay out over a short period of time, you may have more taxable income than you expected. So it's important to think about opportunities for building up Roth money in your retirement portfolio. So as a high earner, it can be difficult to really accumulate Roth funds because you're limited to what kind of contributions you could make to a personal Roth account. But if you have the opportunity to save in your retirement plan, either your 401k or 403b, if you have the opportunity to make Roth dedicated contributions to that, it's worth considering. Now, if you're in the 37% tax bracket right now, chances are you're probably paying a higher rate of tax now than you might in the future, and you may want to prioritize pre-tax. But if you're anywhere from 24 to 32%, it's worth doing some planning to see if it would make more sense to make Roth 401k contributions. Essentially, that's money you've paid taxes on now, but in the future, when you take those funds out, they'll be tax-free, including any earnings that have accumulated in the plan. Now, if that's not totally appealing to you, you want the tax deduction now, there may be opportunities for what's called a mega backdoor Roth, which you might have heard a lot about. That basically allows you to make the standard pre-tax deferral to your 401k and get a tax deduction now for some of the money that you're putting into your 401k, but your plan may also allow you to make additional after-tax contributions, so money that's already been taxed, and then convert those contributions that you made to a Roth source and allow all of those earnings to accumulate tax-free. It can be a really powerful way to build up significant tax-free money for the future, but there's some caveats. Not every plan is going to allow this, and your personal cash flow needs might also not allow this. You may not have the free cash flow to dedicate to something that's a longer-term goal compared to things you might want to prioritize in the short term. So it's worth doing the planning to really see what's going to be the most beneficial for me now in terms of pre-tax versus Roth or after-tax, and consider the right combination of how to get money into those retirement vehicles without creating a really big tax bill for yourself down the road. So second, it's important to invest tax efficiently outside of your retirement accounts. Chances are you're saving and you're investing more money than just in your retirement accounts. And you might be building up brokerage accounts. Maybe that money is earmarked for long-term goals. Maybe it's earmarked for short-term. But regardless, you want to make sure that you're not creating a big tax bill for yourself year to year based on the investments that you have inside of that brokerage account. When you invest in things like mutual funds, for example, which are essentially a basket of a bunch of different investments in one wrapper, you have one investment, it's very well diversified, but that mutual fund itself, as it's being professionally managed, may pass through significant realized gains to you year to year without you actually having sold anything in your portfolio. So realized gains can really take a bite out of your returns and create a tax bill for you unintentionally. Something that we see people have a lot of success with is what's called custom indexing. So if you want a well-diversified portfolio, but you want to track something like an index, People are very familiar with the S&P 500. You could invest in that via a mutual fund. You could invest in that via an exchange-traded fund, which might be a little bit more tax efficient than the mutual fund. Or you can invest in individual stocks that are part of that index. Now, with custom indexing, you don't have to invest in all 500 stocks of the S&P 500 to have a well-diversified portfolio that replicates the performance of that index. Now, why would you invest in individual stocks? There's an element of tax efficiency that comes with this because it allows you to complete tax loss harvesting when positions in the portfolio are down. If you only have one investment, like a mutual fund or an ETF, it's not as easy to do that tax loss harvesting. But when you have the individual components, some things might be up and some things might be down. And when things are down, you can take advantage of that for tax purposes and sell those investments, harvest those losses, and reinvest, stay invested in the market. Custom indexing also goes beyond just tax loss harvest benefits. It can also allow you to create a portfolio that is cognizant of any constraints that you have. Maybe you have preferences about what kinds of companies you want to invest in based on their environmental practices or social or governance. Maybe you have a lot of concentration to one sector because of the stock compensation that you have. Custom indexing allows you to create a very customized portfolio, taking those constraints into account. So you have the power of the tax loss harvesting for the tax efficiency and a really good risk management tool potentially with custom indexing. Now, third, if you have gains and you can defer them where it makes sense, that can also be a way to minimize the tax bill right now and pay taxes at a point in time in the future where you may be in a lower bracket or looking at a lower rate for those taxes. So, for example, say you have a rental property and you want to sell that rental property, but you've taken a lot of depreciation on it and you have a lot of embedded gain that you would realize if you were to sell that property and just take the proceeds. Now, if you're in a position where you don't need the cash from selling that property and you can roll that gain into the next investment property, that's called a 1031 exchange. And that allows you to take the gain and invest it in something else so that you're not realizing that gain in the current tax year. Similarly, if you were to sell something in your portfolio and not want to realize a gain or any other kind of investment, you can roll that gain into something called a qualified opportunity zone. Now, there's a lot of rules associated with these kinds of exchanges, and they really only make sense if you don't need liquidity from the transaction and you can defer that gain into the future when that will be a lower cost for you. There's a lot of hoops you have to jump through. There's a lot of rules, but it can be a powerful way to kind of push that tax bill down the road and keep this tax year more efficient where possible. And finally, it's important to plan smartly for deductions. The tax code is anything but simple, and it actually became even more complicated based on legislation that was passed in the summer of 2025. If you're someone who itemizes your deductions, there's now a lot of different limits that you have to be mindful of. For example, if you pay state and local tax, the amount you can deduct actually increased. But if you make above a certain amount of money, and that amount will shift a little bit every year, that deduction actually starts to phase out and it reverts back down to the lower cap that used to exist. So if you have a lot of income on your return before deductions, you may actually be limited on what you can deduct. There are also new thresholds for charitable deductions that are driven by the amount of income that you have. So there's a lot of interplay between the amount of income that you're realizing and reporting on your return and whether or not you're eligible for the maximum deduction for certain things that you may be doing, like making charitable contributions or paying medical expenses. So it's all a big puzzle, and it's very helpful to be cognizant of just where your income is throughout the year to make sure you're not inadvertently realizing even more income by selling investments and incurring gains, or potentially opting into bonuses that could be paid down the road in a different tax year. It's just really important to be mindful of how all of these things interact and get the right help where needed to make sure you're maximizing every opportunity for tax reduction in the current year. That's a wrap. But before you go, hit subscribe to catch all our new videos. Join our newsletter for access to a private YouTube playlist with insights from our investment management team. Curious how your wealth strategy stacks up? Schedule your complimentary wealth check on our website. Links are in the description below. I'm Emily Harper, here to help you make life option rich. See you in the next video.